All right, we are live, and this is Mike Doyle with the Mortgage Firm. Every Wednesday at noon, I'm here with Elizabeth and Tom, and we're here just to field any mortgage-related questions that you might have. It's an open forum, so we tell everybody grab your lunch and come join us. Today, though, we are going to hit on a topic, and it's going to be home run mortgage. So the home run mortgage is a special pilot program. We're one of a select few lenders that have been chosen, and I believe we're the only one that's based in the state of Florida for this. But it's 3% down, no mortgaging charge. So it's a really good program. So we're excited to talk about this and answer any of your other questions. We'll see if Elizabeth and Tom, you have anything good to add.
Yes, this is just a new program that's really out for limited lenders. We're lucky enough to be chosen as one of them. We're going to go through with you what some of the details are as far as qualifying goes. But it's another first-time buyer program or another program that came out to just help people get in the front door with a little money out of their pocket.
This is actually something very different than what we talked about in the past with like the bonds and all that other stuff. So listen in, because I think this one, some of the benefits are really, I'm not saying one's better than the other. It's not a one-size-fits-all, but definitely something to listen into.
We got a little interference coming through here, so it's breaking up. Are you guys hearing me breaking up too?
A little bit, just on the speakers of the microphones.
Okay. All right. One of the things that I like about this program is a lot of these programs, they come in and they have all kinds of, it sounds great, but then when we see what it actually applies to, it just doesn't apply. And we find out that either the incomes are so low they can't qualify to buy anything, or else the areas that they actually qualify in are areas where they're very restrictive. This one here, you're going to see some of the maps covers a whole lot of areas. So you'll see there's a lot of areas, and if you're buying within these areas, your income doesn't matter. So you can make any income to buy within these areas, and if you're buying outside of these areas, if your income is under 80% of the area median income, you still qualify too.
So we're going to kind of go through some of that, what low to moderate income is, maybe what some of the other acronyms. I guess you'll get CRA, which is Community Reinvestment Act. So these are some of the things that created this loan program.
All right, let's do a little bit as far as the guidelines, okay? And what this program does is Citi is a large company that does a lot of lending, and they're trying to get more out there for their CRA credits, but they're not getting the numbers that they want. They're trying to expand it a little bit more, so they've chosen some other lenders to go ahead and assist them in doing this. So we're using this information. So it's got to be a primary residence. All co-borrowers must occupy the property regardless of the loan to value. So it looks like it's going to be pushing at no non-occupant co-borrowers. Borrowers, non-applicant spouses, fiancés, or domestic partners of borrower may not own or have an ownership interest in any other residential property. So you don't have to be a first-time home buyer necessarily. And in our world, a first-time home buyer means you haven't owned another place within 3 years. In the last 3 years, as far as a primary residence in the last 3 years. But in this program here, you could have owned something 3 years ago, or 2 years ago, or 1 year ago, and you have the ability to still qualify for this program.
The first part there in the first section, if you page down just for a second, I just wanted to point out in the top left-hand corner there, right down, CRA eligibility requirements. So, of course, this is the page that we have to follow to see, if not only the borrower qualifies, but if the property itself qualifies. So that CRA eligibility requirement is Community Reinvestment Act. And this is where we have to look up on the LMI, or the low to moderate income census tract, to see if the property falls within that given area to qualify for this loan program. So there's a few things that we have to do to confirm that the property and the borrower fall under the guidelines. But I just wanted to point out what some of those little acronyms meant.
Now, one of the things is we call it a manual underwrite. So in general, what we do, we plug the information in, and then we run it through LP, which is Freddie Mac's program, or we run it through DU, which is Fannie Mae's program. And it'll spit out an approval for us. But this is a little bit more old school, where it's a manual underwrite, where it has to fall within certain parameters, and it has to be reviewed by the underwriter before we get an actual approval. So where we'll advertise that I'll close a contract next week, we're not going to be advertising on this one that we get a contract this week, we close next week. We're going to want a little bit more time because we have a few more steps we need to be able to go through. but it's an excellent program. It's conventional loan, 30-year, 25, 20, 15, and 10-year fixed rate loans. Now, I would be curious to price their stuff out, but right now, I don't know, we're not getting a whole lot of improvement on rates on 25 and 20-year rates, maybe a tad. The 15's a little bit more, and then the 10. I haven't done a 10-year loan in the last year, probably. It's for one unit, condos, PUDs, and co-ops. And I know Tom likes to advertise himself as the co-op expert. So bring out the Tom.
Yes, bring them on.
I like condos, love condos.
I tell you, it's a little interesting though, because the co-op coverage has been pretty poor, but there are some co-op opportunities out there that get missed. I'm wondering if this might be a good avenue for some co-ops.
You know, believe it or not, it's hard to find a loan for a co-op because of the ownership situation. But there is, you're right, there is opportunity out there to find a couple.
Yeah.
So,
Now it still goes through, like on the condos, you got to get the condo approved.
right.
So you will have to get your condo approved. So the co-ops will have to have certain approvals also. We'll have to take a look and dig into those a little more. Now duplexes though, it qualifies for duplexes. So you can buy a 2-unit complex as far as a duplex and get that done. So that's very. All right, condominium co-ops must be approved. Limited condo reviews are permitted, providing they meet specific guidelines. Okay. Everybody's got to take a home.
Limited condo reviews are permitted, I guess, at the same loan to value. It doesn't say that there's a loan to value adjustment.
Yeah, 25% for primaries. It's going to be probably, I'm sure, at least 25% down.
Yeah, that's something that I do want to touch on because we've had lately a lot of people ask me also about the condo, the limited versus the full condo reviews, the reserves, the new law that came into play. So I think a lot of people are starting to kind of, you know, with the having the enough reserves in there. So just know that 25% is for a limited condo review. We don't have to see reserves. Anything under than that, under 25, we have to do a full condo review. And I know there's a lot of condominiums out there that eventually they will have that 10% of their budget, but that's not happening right this minute.
Tell you, we were killing it on condos. I feel like we were getting a little too confident or cocky this last year on condos. We were getting full reviews. We were just, they were flying through. I have never ran into so many problems on condos right now. One of the things that you run into is insurance has gotten so expensive. We've had a couple recently where they're doing a 10% deductible on insurance, and Fannie and Freddie don't allow 10% deductibles on condo insurance. So there's just a lot of little things we're running into. And then also, you know, deferred maintenance. And every condo in South Florida's got some cracked stucco or something like that. When the condo questionnaire comes back and starts talking about deferred maintenance, you know, that you've had for a couple of years, there's potential problems. So, you know, that deferred maintenance, which is even a question on a limited review, has the ability to come back and get you too. But yeah, condos have gone back to being difficult again.
Yeah, ever since the Champlain, I think it was Champlain, it was called, whatever building regretfully collapsed. Yeah, that you know, got all this new regulation underway.
Yeah, and look at the structural, and you like to see everybody addressing, you know, some of the structural problems that a lot of these condos, especially the older ones over on the beach, could have. So you definitely want them to look at that. But you know, it's affecting a lot of, you know, even newer and not so old, like 2-story condos. You know, so I think we've had, you know, one condo collapse as far as I've ever known. But you know, it's going to be the kind of thing where the pendulum's going to shift. You know, it's shifted, and everybody's going to have to get very diligent about it until we find like a middle ground that works. But at least everybody's starting to address some of these issues they need to address. So, all right, you can see we do also have some credit score requirements. So, you know, at 97%, you know, you can do 1% down of your own money. So if you have some other stuff, other help, 1% of your own money is all you need. But, you know, our housing ratios are a little bit tighter, like 43%. But you're not paying mortgage insurance, so it's not that restrictive. 640 credit score is going to be your minimum. You know, if you're looking at a, you know, 640, but you'll need 2-month reserves, and then you have a little bit more restrictive the housing ratio, which means the percentage of your income that can go to your housing. So right here, the percentage of the income is, if you have a 640 credit score, is 38% of your income, which isn't a bad percentage to kind of be looking at. So,
One thing that just make sure you did hear right. Mike said you're not paying mortgage insurance. So it wasn't a whoops. This is just this special program that it's not. And one of the things that I know that we inquired on is, are we taking a hit on the rate just because of the not having the mortgage insurance on there? And the answers we've been getting is no, it doesn't have it's not like it's going to be blended into your rate just because you're not being charged the mortgage insurance. So there's still competitive rates. You're not getting hit on the other side just because you're not being charged the mortgage insurance.
Look at this here. Duplex, 10.01% down. No mortgage insurance. 10.01% down. No mortgage insurance. 6 months of reserves, though. So you have to have a little bit of money. And they don't want you moving into the house and having no money. So got to have just a little bit of reserves. Up here, 1 month of reserves, 2 months of reserves. And I know for a lot of customers right now, you move in and there's just nothing out there.
And what is defined by the meeting reserves in our industry is, if you page up a little bit, it'll say 2 months, 6 months, whatever they require. It's the total housing expense for the property that you're purchasing. So the principal and interest, the taxes, the insurance, any HOA fees, multiply that by either 1 month, 2 months, 6 months. That's how many months in reserves that are required to have in your account after closing. All
right. All right, now minimum FICO, here we have conforming loan amounts, non-traditional credit. So non-traditional credit, you don't have to have a credit score for this. So if you have non-traditional credit applies to borrowers that don't have a score due to insufficient credit. Okay, so it's not that you're locked out or you put some freezes on your credit scores, but you're going to have 4 sources of non-traditional credit for each borrower must be documented. All sources must have been active for 12 months. So we're looking for electric bills, car payments, car insurance, anything, different types of utility bills. Rent is a great one. So generally we pull from a couple different columns and we start building 4. And if we can see those, we go and we qualify you. Now, the one thing, non-traditional credit is not permitted for a duplex. So not for duplexes. The non-traditional credit, this is what I need to take a look, though, is conventional loans are very credit score driven. Now, that's one of the reasons why we like the Hometown Heroes is Hometown Heroes, you price out at a 640 credit score, you get the same interest rate as somebody with an 820 credit score. So Hometown Heroes is great as far as that. Now, this year is going to, we priced out a couple earlier today, and it is going to be a little bit credit score driven. So. All right, and this is an example that they gave. Let's get this. And they're basically just saying, let's say you look at the home run program versus the home ready, home possible, which is our other 3% down with MI program, and versus an FHA. So you can see that the city, this home run program is 3160 versus the home possible is 3530. So I mean that's $370 a month cheaper, and for FHA, you're looking at $284 a month cheaper. Plus FHA, you've rolled a good chunk. You have an FHA funding fee that gets rolled into the loan. So now you're borrowing $8,000 more, close to $9,000 more by having an FHA loan. So this is one that if we can get you to qualify on this one here, we'll be pushing this one pretty heavily over FHA. And I'm trying to think the home run loan, or I'm sorry, the Hometown Heroes, if you really have no money, Hometown Heroes may be the way to go. But this is going to be a toss-up, really, between Hometown Heroes and Home Run. So,
yeah, the biggest thing I think, would be the debt to income. This program is a great program. Obviously, it just holds you a little bit tighter to your debt to income numbers than the median. That's why it's just another option that we can offer our borrowers. There's so many loan programs out there, but yeah, it's definitely a good loan program with no mortgage insurance.
Yeah, this is actually the great example. Also, whenever we do, Mike, our pre-approvals, when you see that, you do the 500,000. Let's just take this as an example, and then you do the 3.5% FHA. I've had people come back and say, well, that's not the amount of the loan if you take 3.5%. Mike just pointed that out. they do have a fee that FHA tags along. So you are adding more to your loan amount. So I mean, this is a great example, because even with the FHA mortgage insurance premium going down on a monthly basis, you're still paying mortgage insurance, and this is actually doing away with that. So
Yeah, the FHA upfront mortgage is right there at 1.75, like you pointed out, and then so that you're not using it all with this program. You're not spending that money at all,
exactly.
or financing a larger amount.
All right, let's take a look at some of these maps, because again, it comes back to, in my mind, when this first came up, like, I've seen these maps before. I've seen these low income maps before, and they're just not even workable. So in here, let me blow this up a little bit. This here is West Palm Beach area. So let's go ahead and just take a look at that a little closer. So if you come in here and you start looking, that's a lot. That's a lot of West Palm Beach right here. A lot of West Palm Beach. So, not a lot of Delray, but LakeWorth, West Palm, Green Acres. That's a good chunk. Like you can see right here, this is the B line. So the B line's going up, and you can see you have all this area here of West Palm Beach, and then you have a good chunk of LakeWorth and Green Acres that all qualify. And then you can come out to Royal Palm Beach. I mean, here you're out at, you got Southern Boulevard, and then you've got 441. So you have a good chunk of a couple nice neighborhoods through there that will all qualify. Mm-hmm. So these are all pretty good areas for first-time home buyers. And you look at Boynton Beach through here. I mean, right here, it looks like between 95 and US 1, you've got a good chunk of Boynton Beach. Not so much a good chunk of Delray Beach, though, and a very small chunk of Boca Raton. But geez, Coral Springs has got a little bit too. Tamarack, Springs, Pompano Beach, all some decent areas.
No down payment assistant for Boca Raton? Excuse me.
Yeah.
They made the map.
Little pocket here in Boca. Right there, you got a little pocket in Boca. That 3% down, no MI. So.
There's actually a website that we need to go to, that we go to, and we plug in the address, and the address tells us if you fall within that, or if the property you're interested in falls within the area that this program is available for.
Yeah, you can go ahead and plug in the address, and
Yeah.
You said that's on the. Tell me again that website there.
Yeah, it's that one.
E-Programs website.
Yeah, it's on the e-housing program, or e-housing plus, I think, where you can look up the. You plug in the address, and it'll tell you if it's FEIN or TEIN or something like that. That's in the corner there. We can look it up. You can see how well I know. I could see it. I know it if I see it, but.
There. Well, let's pull it over here so you can see where you are. So let's run it. You run it in the hometown here, one.
Here, let's see.
Now, which one do you run through here, Tom? You said you run it through here?
There's usually an address here. Summary office guidelines. Go to ePortal and see if it's in there. To look up the ad.
ePortal. You go off of this program. You don't go off of this page, right?
Click around, because you know what? I'll know it when I see it. This is usually the starting point, and then it allows me to click on a map, and if we can't find it here, I'll find it.
I just emailed it to you, Mike.
Yeah. All right, that's fine.
What's up there?
We'll pop over real quick back into the but as you're looking, like I said, we've got somebody buying in West Palm right now. The contract just came in. They lined up really well. They're a young professional, works at a big company here, and they bought right in this West Palm area, and it works out perfectly. So again, they're doing 10% down, but it's 10% down, no mortgage insurance, and the interest rate is good, and there's no points on the pricing prices out really well with the traditional type loan, but there's just no mortgage insurance. So again, it's a great loan. We also have some other community lending programs that'll give you $1,000 credit, and sometimes they'll give you 1/8 of a point better. So the biggest thing I say with everybody is, I keep running into lenders and they're like, that's a bad program. That's a gimmick. That's, I'll hear something negative on those. But a lot of the times I hear the negative on the stuff that they don't offer. So everything has some good and some bad. I call it the good, the bad, and the ugly, as we always talk about. And it doesn't matter what it is, any big decision or anything of importance or financial decision, you're going to have some good and some bad. But it's just, is it an 80-20, 80 good, 20 bad, or is it 20 good and 80 bad? So what we're weighing out these things is, what's the good, what's the bad, and what's the best one for you. So we want to make sure that we have the programs available for you, and then we can talk about your situation and which choices work best for you. So be careful when you're talking with lenders. Are they bad-mouthing products because they're just not available to them? So
availability and also knowledge, because I think like when we saw this during the Hometown Heroes, everybody was like, oh, it's so hard to reserve. And I'm like, it took me 10 minutes or less to reserve. Once we start getting used to the reservations, it's like minutes to do that. So, just you're right. If they don't offer it, a lot of times they'll badmouth it or just the lack of knowledge. So just find somebody that, call us, we'll tell you. And we're not going to stick you in this program just because we want to go ahead and use it. We're gonna make sure that it's the right option for you. I mean, I've had people even in the past that I talk to them about Hometown Heroes. They come with, with the mindset that I'm going to do a Hometown Heroes loan, and then we end up not doing it because we find something that's that's more beneficial or something that they may not need at all. So just know that that's what we're here to do, is just to guide you.
I always get, I know Elizabeth does this a lot and Tom does a lot, where, I refer a lot of business out to banks for lines of credit, just different places. I always want everybody to just feel that, we're their first phone call. Give us your first phone call, tell us your situation. And if we have a program for you, that's the best program, then we're going to do it. If we don't have that best program for you, then let me refer you out to somebody else. But I know in my life, I always find I just find it ironic or coincidental that when I ask people for their best advice, their advice always seems to be what pays them money. So I'm always want to make sure that, we're here to close loans, but we can do lines of credit, not always. Some of the lines of credit we can do, other banks can't do. And if they can't do it, then, we'll do it. But I generally refer lines of credit out to people, and I try not to get people to refinance out of their very low interest first mortgages because they're trying to get $20,000 line of credit. So I'd rather you go to the bank first, see what you can get, what they offer. So the same thing goes with this is, we have multiple programs available. We want to make sure that we're giving you the range of programs that work for you, and you can make the decision. We don't want to go ahead and just be bad-mouthing programs because it's just something we don't offer.
We're going to treat you like family. That's The Godfather. Did you like my Godfather impression? Wait, hold on. Let me do that. Yeah, what? We just want to give you the best options for your situation. Loans, as we know, we've been doing this long enough, are like fingerprints. Every one of them is different. Everybody's situation is different. My income, your income, their assets, his assets, gift owners, all these puzzles we need to put together. So this is why we ask so many questions. And this is why we go through these loan programs, to find out which one best fits your situation. So
I tell you, Coral Springs, Pompano Beach, Plantation, Pembroke, Hollywood. I mean, this is a very, very far-reaching program. I mean, look at Miami as you come into Dade County. I mean, most of Dade County qualifies. It's absolutely incredible when I look at what qualifies in Fort Lauderdale. And then I just hung up with somebody who's looking at buying in Dade County. And it's unbelievable what areas everybody's qualifying for. Now, let's see if we get.
And we're licensed in the whole state of Florida, so we do closings all over the place. So just give us a call if you have something in mind that you want to purchase. We could go ahead and help you.
Or if you're looking to move to Georgia, we'll be happy to help you move to Georgia.
That's right. We got Tom licensed in Georgia. It's Tom, Georgia and co-ops. Is that?
Yeah, Georgia co-op, non-warrantable condos, you name it.
USDA, all those are yours.
Manufactured, I got it covered.
And we closed the manufactured home last week. So, I mean, we do manufactured homes.
Yeah.
When we joke around, just obviously because I think like some are a little bit more challenging. I won't say impossible, because we will find a way around it, but just bring us your scenario. What is it that you're looking for? We'll help you, work around it.
Yeah. So, but again, it comes back to no income restrictions on these things here. I mean, you fall within these areas and you're in a good spot. So, we have a couple programs like that, there aren't income restrictions, and some of them, some of the things where we have income restrictions, like the Hometown Heroes is up to, what was it? What Palm Beach County is, Hometown Heroes up to $148,000 now. So you're talking about income, that's substantial income, then you still qualify for these programs.
Yeah.
So this one here, like I said, I'm very excited about this program here.
Well, the good things about these loan programs we find that have recently come out is they were smart enough this time around to adjust the income according to the market value of properties, nowadays. So, again, you can't have the average home now be 400,000 or 500,000 and have an income limit of 50,000 a year to qualify. So, luckily they adjusted the annual income limits according to the prices of houses.
Yeah. Now we got a couple questions here, and one question we have from Rob is, can this be combined with other types of seconds? So yes, it can. So we can go ahead and combine these with other types. Now it's not going to be the bond program or the Florida Housing Bond Program, because that has to be done through specific lenders. But there are other community type seconds out there that you can combine. So with these programs, when you start combining different community seconds, you can go ahead and you can get to the point where the customer is only putting 1% of their own money down, which is the minimum.
And that's where that CLTV comes from, I think, on that page where we kind of went down a little bit of the loan to values versus credit scores. That's where the combined loan to value is. So your first loan is basically 3% down, and I think your second loan is what, 5% on that CLTV page, something like that.
Yeah. Okay. Now, also questions as far as what's the savings on the mortgage insurance. Well, the savings on mortgage insurance is, again, mortgage insurance is very credit score driven. So if you have great credit scores, your mortgage insurance can be, the factor can be tiny. So the difference can on a $400,000 loan can be $300 a month. I mean, you could be looking at substantial differences as far as your monthly payment goes based off of your credit scores. So there's not an exact savings on it, but if you fall within the debt to income requirements, you fall within the certain types of credit requirements, and we are able to prove you with a manual loan or a manual underwrite, that MI is gone. It's just gone. So it doesn't matter if it was $50 a month or if it was $300 a month, the MI is gone. So these programs actually favor those that might have not the perfect credit, maybe a little bit lower credit, because for the most part, they're going to end up with the same monthly MI payment as somebody with an 800 credit score if you only have a 660 credit score.
And the other thing this is saving you, it's saving you the cost and the expense of refinancing in the future to get rid of mortgage insurance. Because typically on an FHA loan or a conventional loan, you look to get rid of the mortgage, or on an FHA loan, you look to refinance out of that loan in the future to eliminate that payment. Even this loan, you don't have any mortgage insurance, so there's no mortgage insurance to refinance out of.
Yeah, I would say also just, I'll go on, Tom.
No, that was good. That was my speech.
I mean, there's no crystal balls. I mean, we'll say there's no crystal balls. And one of the documents you'll sign at closing is saying that nobody should be saying, oh, we're just getting you in this, but you'll refinance. So we should never be selling anything with the expectation that the refinance is around the corner. And we don't know what's going to happen. I mean, the projections are that over the next 2 years, we will be looking at rates going to the point where it will make sense for people to refinancing out in 2 years. So the nice thing with this one here, with the no mortgage insurance, and you get a good rate and you get good cost, everything like that, is you don't have that community second that you have to pay off, because so many of these community seconds, there are no mortgage, there are no payments, no interest, which is great. Somebody gives you money now, no payments, no interest, and you pay it back at some time in the future. Most people will say, do it. But when you go to refinance in a year, 2 years, 3 years, whenever the time comes, if it comes, you have to get that $20,000 back. And we make that very clear to our customers, but I'll tell you what, a good chunk of them are not going to have that $20,000 just to hand back on the refinance. So if the rates drop substantially, they may not be able to have the opportunity to take advantage of that lower rate because they don't have the money to pay it back.
A lot of people, I think, are also dependent on what the value of the property is, and we can't guarantee that that value is going to go up. So, obviously, you don't come out of pocket for the refinance, but during the refinance, we would be able to roll that into the loan. But if your property doesn't come back valued, I mean, we seriously were kind of still are in the time where property values are hitting their highest.
Yeah.
So we can't guarantee that when hopefully it's soon, but 5%'s come around, that we're going to be able to use the equity in your property to be able to refinance and stick this $20,000, like Mike's example, into the loan, because we don't know what those property values are going to be then.
Yeah. Wow. I can't believe it's 12:30 already. That seemed to be, I love this home run program. We're going to have to probably do this again. So I'd like to, hit on this again. And actually with the Hometown Heroes opening up to everybody in July, we'll probably go ahead and hit the Hometown Heroes maybe next week again. So we'll hit Hometown Heroes. We'll hit the Hometown Heroes again, and maybe we'll catch a couple more down payment assistance programs that are out there. But yeah, we've run through our 30 minutes. I tell you tonight, Elizabeth, are you doing PR Bakery tonight?
PR Bakery tonight. So besides the fact that they have absolutely amazing food there, we actually have a lot of fun. We do raffles, and it's usually from 6:30 to 7:30. Sometimes we go a little bit over because there's just so many questions we want to make sure we answer. But we'll get a lot of one-on-one time, and we'll go through the first-time home buyer, any questions you may have, and I'll go over the Hometown Heroes program. I'll go over this program tonight. So more than welcome to join us. So PR Bakery on Military. Don't know exactly what the address is, but it's on Military. I believe it's just after Hyperlux. So
plug in PR Bakery into your Google Maps or your Apple Maps or whatever maps you use, and it'll bring you right there. And this one is especially geared for Spanish-speaking customers. Elizabeth is bilingual, English, Spanish, and we want to welcome everybody there. And also, we have new mobile apps and applications that are in Spanish too, correct?
Correct.
Yeah. And also 6:30 Zoom every Wednesday night. We have our home buyer class. So go to TMF Classes, the mortgage firm, tmfclasses.com. Sign up for one of the classes, get the Zoom link. And this coming Monday, we have a mortgage class geared for realtors. So sign up for one of those classes. And then we have a Zoom mortgage class 6:30 next Tuesday for Spanish-speaking customers also. So tmfclasses.com, go sign up. Go to our Facebook page, the mortgage firm, Wellington, LakeWorth, and go ahead and like and follow. And we look forward to seeing everybody next week.
Thank you.
Thank you.